In the bitter freezing twilight of March 3rd, 1933, the American financial system was not merely bending under the weight of the Great Depression, it was actively, violently disintegrating. Across the nation, from the sprawling financial centers of New York and Chicago to the dusty, wind-swept agricultural towns of the Midwest, a primal, contagious panic had taken hold of the populace. Millions of ordinary citizens, driven by terrifying rumors and the undeniable reality of shuttered storefronts, descended upon their local bank branches. They formed massive, desperate lines that stretched around city blocks, standing for hours in the biting winter cold. These were not speculators or Wall Street gamblers. They were factory workers, farmers, teachers, and shopkeepers. They were gripping their leather-bound passbooks, desperate to reach the teller window and withdraw their life savings. They demanded physical currency, and more importantly, they demanded physical gold. But the terrifying truth, a truth that was about to be brutally exposed to the entire nation, was that the vaults were functionally empty. The money was simply not there. To comprehend the sheer scale of the catastrophe that culminated in the spring of 1933, one must peer behind the curtain of the banking industry and understand the lethal mathematics of fractional reserve banking. When a citizen deposits $100 into a commercial bank, the bank does not place those bills in a dedicated safety deposit box with the depositor's name on it. The moment the cash crosses the teller's counter, the legal reality of the relationship fundamentally changes. The depositor ceases to be the owner of that money. They become an unsecured creditor to the bank. The bank takes that deposit, keeps a microscopic fraction of it in reserve to handle daily withdrawals, and immediately loans the vast majority of it out to borrowers, often tying the capital up in long-term illiquid assets like 30-year mortgages or speculative corporate debt. Under normal psychological conditions, this system operates smoothly, as long as only a small percentage of depositors ask for their money on any given day. The illusion of total liquidity is perfectly maintained. But fractional reserve banking is entirely dependent on absolute, unwavering public confidence. It is a financial game of musical chairs played on a societal scale. When a macroeconomic shock occurs, like the catastrophic stock market crash of 1929 and the subsequent wave of industrial bankruptcies, that confidence evaporates. Depositors realize the music is stopping, and they all rush for the chairs simultaneously. Because the bank has loaned out 90% of the deposits, it cannot mathematically satisfy the demands of a sudden mass withdrawal. It is structurally insolvent by design. Between the initial crash in the autumn of 1929 and the chaotic winter of early 1933, the American banking system experienced a slow-motion, agonizing bloodletting. More than 9,000 individual banks failed completely, permanently, wiping out over 9 million individual savings accounts. Billions of dollars in uninsured deposits were simply erased from existence. There was no Federal Deposit Insurance Corporation, FDIC, to step in and make the depositors whole. If your local bank failed, the iron grates were pulled down over the windows, the doors were locked, and your life savings were instantly, permanently vaporized. Your labor, your frugality, and your future were liquidated to cover the bank's bad bets. By February 1933, the localized bank runs had metastasized into a systemic, nationwide contagion. The panic became a self-fulfilling prophecy. Even healthy, conservatively managed banks were being dragged into the abyss because they were forced to dump their highest quality assets into a deeply depressed, illiquid market at fire sale prices just to raise the physical cash needed to meet the endless lines of terrified depositors. Recognizing that the entire domestic financial apparatus was hours away from total annihilation, state governors began taking desperate unilateral action. The governor of Nevada was the first to declare a localized bank holiday in late 1932. Legally ordering the banks in his state to close their doors to prevent them from being bled dry. Louisiana soon followed. By the middle of February 1933, the governor of Michigan, faced with the imminent collapse of the massive Guardian Detroit Union Group, declared an 8-day banking moratorium. This was the tipping point. Michigan was a major industrial hub. When its banks closed, corporations could not access their funds to pay suppliers in other states, causing the contagion to instantly jump the borders. Panic swept through Indiana, Ohio, and Illinois. By March 3rd, the governors of New York and Illinois, the beating hearts of the American financial system, were forced to declare statewide bank holidays. The financial circulatory system of the United States had suffered a massive terminal cardiac arrest. Simultaneously, a second, even more dangerous run was occurring at the highest echelons of global finance. Wealthy American industrialists and foreign central banks, terrified by the prospect that the United States government might devalue its currency to print its way out of the Depression, began aggressively dumping their paper dollars and demanding physical gold from the Federal Reserve. The U.S. Treasury was hemorrhaging its sovereign gold reserves at a staggering and unsustainable rate. The Federal Reserve Bank of New York, the primary custodian of the nation's gold, saw its reserves drop perilously close to the statutory minimum required to back the paper currency in circulation. The United States government was staring down the barrel of a sovereign default. They were days away from having to publicly admit that the US dollar was no longer as good as gold. This was the apocalyptic landscape that greeted Franklin Delano Roosevelt on the morning of his inauguration, March 4th, 1933. In his famous inaugural address, Roosevelt sought to calm the terrifying psychological storm, declaring that the only thing we have to fear is fear itself. He blamed the crisis on the unscrupulous money changers, who had fled from their high seats in the temple of our civilization. The rhetoric was soaring, masterfully designed to project strength and resolve to a shattered nation. But rhetoric does not solve mathematical insolvency. Behind closed doors, the Roosevelt administration was frantically preparing to execute one of the most drastic, unprecedented, and legally questionable peacetime maneuvers in the history of the American Republic. The newly sworn-in president understood that if the banks opened for regular business on Monday, March 6th, the remaining gold would be drained. Every major financial institution in the country would fail, and the United States would likely descend into open, violent revolution. Late in the evening on Sunday, March 5th, the White House drafted a sweeping executive order. To bypass the lengthy, unpredictable process of congressional debate, Roosevelt's legal team resurrected a forgotten, wartime statute passed during the height of World War I, the Trading with the Enemy Act of 1917. This act was originally designed to give the president extraordinary executive powers to seize the assets of hostile foreign nations and prevent the funding of the German war machine. In a stunning display of executive overreach, Roosevelt weaponized this wartime statute against the domestic population of the United States. He legally classified the American citizen as desire to withdraw their own property from a failing banking system as a hostile act that threatened the national security of the Republic. At 1 a.m. on Monday, March 6, 1933, President Roosevelt officially issued Proclamation 2039. He declared a nationwide, mandatory bank holiday. From Monday, March 6th through Thursday, March 9th, every single banking institution in the United States of America was legally ordered to close its doors and cease all operations. When the sun rose on Monday morning, the American public awoke to a staggering dystopian reality. The financial system had simply been turned off by executive decree. The steel vault doors were locked, the tellers were gone. Heavily armed guards and local police were stationed outside the banks to ensure absolute compliance. It did not matter if you were a wealthy industrialist needing to make payroll for thousands of factory workers, or a desperate mother needing $3 to buy groceries and milk for her children. You were completely, unequivocally locked out of your own wealth. The government had unilaterally severed the citizen from their private property to protect the institutional solvency of the banking cartel. The fundamental illusion of the banking system, the belief that your money is always there, waiting for you whenever you need it, was shattered overnight. The state had asserted its ultimate absolute authority over the financial destiny of the individual. When the nation awoke on Monday, March 6, 1933, the United States economy had been effectively thrown into an induced coma. The immediate practical consequences of the bank holiday were devastating and entirely unprecedented in American history. Commerce, which relies on the frictionless movement of capital, ground to a violent halt. Without access to checking accounts, employers could not meet their weekly payrolls. Factory workers, who lived paycheck to paycheck even in the best of times, were handed IOUs instead of cash. Travelers found themselves stranded in foreign cities, unable to pay for train tickets or hotel rooms because their out-of-state checks were suddenly worthless pieces of paper. Small businesses, from corner grocers to local pharmacies, faced an impossible dilemma: extend unlimited credit to their starving neighbors and risk their own total bankruptcy, or demand physical cash that simply did not exist in circulation, thereby turning away desperate customers. In the absence of a functioning banking system, the American people were forced to rapidly devolve into primitive economic survival mechanisms. Across the country, localized barter economies spontaneously erupted. Citizens traded eggs for medical care, chopped wood for groceries, and utilized postage stamps, subway tokens, and even Canadian currency as makeshift mediums of exchange. Municipalities and large corporations began printing their own localized scrip, essentially private fiat money, just to keep their local economies from entirely collapsing into anarchy. The psychological trauma inflicted upon the populace during this week was profound and permanent. It was the exact moment when the romanticized illusion of the American banking system died. The working class learned through bitter, freezing experience that a bank deposit was not money in a vault. It was an unsecured loan to an institution that could be shielded by the federal government at a moment's notice, leaving the citizen completely financially abandoned. While the American public scrambled to survive the week, a frantic, highly secretive operation was unfolding behind closed doors in Washington, D.C. The Roosevelt administration, working in close, uninterrupted collaboration with the very same Wall Street bankers who had engineered the crisis, drafted the Emergency Banking Relief Act of 1933. This legislation was not designed to fundamentally reform the predatory nature of fractional reserve banking or to protect the depositor. It was a massive, centralized rescue package, meticulously engineered to save the banking cartel and consolidate absolute financial power within the executive branch. The passage of this act on March 9, 1933, stands as one of the most glaring subversions of the democratic legislative process in the history of the Republic. When Congress convened in a special session to vote on the bill, there were no printed copies available for the representatives to read, analyze, or debate. The text had been finalized only hours earlier. The chairman of the House Banking Committee literally stood on the floor of the House of Representatives holding a folded newspaper, pretending it was the bill, and shouted the broad outlines of the legislation to the assembled lawmakers. Driven by an overwhelming atmosphere of engineered panic and the threat of total societal collapse, the House passed the bill unanimously after only 40 minutes of debate. The Senate followed suit shortly after. The President signed it into law that same evening. In less than 8 hours, the United States Congress surrendered its constitutional authority over the nation's monetary system to the executive branch without even reading the text of the surrender. The Emergency Banking Relief Act granted the Secretary of the Treasury dictatorial power to decide the fate of every financial institution in the country. The Treasury Department rapidly divided the frozen banks into 3 distinct categories. Class A banks were deemed entirely solvent and were permitted to reopen immediately. Class B banks were deemed structurally impaired but salvageable, requiring injections of fresh capital from the Reconstruction Finance Corporation, effectively utilizing taxpayer money to bail out private banking losses. Finally, Class C banks were deemed hopelessly insolvent and were ordered to remain permanently closed, liquidated by government conservators. If your life savings happened to be trapped inside a Class C bank, the federal government officially signed the death warrant on your wealth. There was no appeal process. The state chose the winners and the losers, cementing the survival of the largest, most politically connected financial institutions, while allowing thousands of smaller regional banks to be wiped from the map. With the legal architecture in place, the Roosevelt administration executed a masterful, unprecedented psychological operation to restore the public's faith in the fractional reserve illusion. On Sunday evening, March 12th, the president delivered his very first fireside chat over the national radio networks. An estimated 60 million Americans tuned in to hear Roosevelt explain, in calm, patronizing, and deeply reassuring tones, the mechanics of the new banking system. He assured the terrified populace that the banks reopening the next morning had been rigorously audited and were now entirely safe, implicitly backed by the full power of the federal government. He explicitly told the citizens that their money was safer in a reopened bank than it was hidden under their mattresses. The psychological operation was a staggering success. When the Class A banks unlocked their doors on Monday, March 13th, the chaotic, panicked lines of the previous week had completely reversed. Instead of demanding physical cash and gold withdrawals, citizens lined up to deposit their hoarded currency back into the system. The panic had been broken, not by fundamentally altering the mathematical insolvency of the banking system, but by replacing the local bank's credibility with the perceived omnipotence of the federal state. However, the bank holiday and the subsequent reopening were merely the prerequisite maneuvers for the true, devastating wealth transfer that was about to occur. The federal government had stabilized the banks, but the Federal Reserve was still dangerously constrained by the gold standard. Under the law, the central bank was required to hold physical gold backing for 40% of all Federal Reserve notes in circulation. Because terrified citizens and foreign entities had drained massive amounts of gold from the system leading up to the holiday, the Federal Reserve could not legally print the billions of dollars. In new currency, the Roosevelt administration desperately needed to fund the sprawling, expensive, and radically interventionist programs of the New Deal. To expand the monetary base and reflate the economy, the government required physical gold, and because they could not mine it fast enough, they decided to simply take it from the citizenry. On April 5, 1933, President Roosevelt issued Executive Order 6102, arguably the most draconian and unconstitutional economic decree ever enacted in the United States. Citing the national emergency powers granted to him by the blindly passed Emergency Banking Relief Act, Roosevelt made it a federal crime for any American citizen, corporation, or partnership to own or hoard gold coin, gold bullion, or gold certificates. The order legally compelled the American people to surrender their private, physical gold wealth to the Federal Reserve by May 1st. In exchange, they were handed paper fiat currency at the legally fixed rate of $20.67 per ounce. The penalty for refusing to comply with this mass expropriation of private property was brutal and absolute, a staggering $10,000 fine, equivalent to hundreds of thousands of dollars today, and up to 10 years in federal prison. The government deployed aggressive propaganda campaigns, framing the hoarding of gold not as a rational financial defense against bank failures, but as an act of economic treason. They branded citizens who wished to retain their hard money as selfish hoarders who were actively prolonging the Great Depression. Terrified by the threat of imprisonment and conditioned by the patriotic fervor of the era, the vast majority of the American public complied. They marched into local Federal Reserve branches and commercial banks, handing over millions of ounces of physical generational wealth in exchange for paper receipts that were backed by nothing but the promises of the politicians who had just forced the exchange. Once the physical gold had been successfully confiscated and locked deep within the vaults of the Federal Reserve and the newly constructed United States Bullion Depository at Fort Knox, the trap was aggressively, violently sprung. In January 1934, Congress passed the Gold Reserve Act, which officially transferred ownership of all the confiscated gold from the Federal Reserve directly to the United States Treasury. Immediately following the passage of this act, President Roosevelt executed the final mathematical phase of the theft. He arbitrarily and unilaterally redefined the value of the paper dollar. He raised the official government price of gold from the 20.67 per ounce that the citizens had been paid to a new fixed rate of 35 öre per ounce. With a stroke of a pen, the federal government instantly devalued the United States dollar by nearly 60%. The paper currency that the citizens had been forced to accept in exchange for their gold was suddenly worth drastically less in terms of international purchasing power. Conversely, the physical gold that the government had just confiscated from the populace instantly skyrocketed in nominal value. The Treasury Department booked a massive unearned multi-billion-dollar windfall profit overnight. This was not an economic policy. It was a highly coordinated, state-sponsored heist. The government effectively stole the physical wealth of the American middle class, revalued it higher to enrich its own balance sheet, and left the citizens holding a rapidly depreciating fiat currency. The secret bank holiday of 1933 was never truly about protecting the depositor. It was about freezing the financial exits, consolidating power, and executing the largest, most audacious confiscation of private property in the history of the modern world. The psychological masterstroke of the 1933 bank holiday was not merely the confiscation of physical gold, but the permanent institutionalization of the fractional reserve illusion through the creation of the Federal Deposit Insurance Corporation, or FDIC, to convince the traumatized American public to surrender their hoarded fiat currency back into the very vaults that had just betrayed them. The federal government had to fabricate an impenetrable shield of perceived safety. The FDIC was branded as an ironclad government guarantee, a solemn vow that no citizen would ever again lose their deposits if a local bank collapsed. But beneath the polished brass plaques and the comforting government seals affixed to every teller window in America, the FDIC is, mathematically speaking, an undercapitalized psychological pacifier, designed specifically to prevent mass panic, not to survive a systemic financial contagion. The mathematics of the FDIC are terrifyingly fragile. By design, the Deposit Insurance Fund maintains a reserve ratio that hovers slightly above 1% of the total insured deposits in the United States banking system. If a single mid-sized regional bank fails due to localized mismanagement, the FDIC has the capital to step in, make the depositors whole over the weekend, and seamlessly transfer the accounts to a healthy institution. The illusion of safety is flawlessly maintained. However, if a systemic macroeconomic shock triggers a simultaneous run on multiple massive financial institutions, a scenario exactly like the cascading failures of 1933 or 2008, The FDIC insurance fund would be vaporized in a matter of hours. The money simply does not exist to cover a national banking collapse. In the event of a true systemic crisis, the FDIC is nothing more than a toll booth on the road to the Federal Reserve-S printing press. The only way the government could honor the FDIC guarantee during a catastrophic collapse would be to print trillions of new fiat dollars out of thin air, effectively returning your lost deposits to you in a currency that has been violently hyperinflated to worthlessness. The true, lasting legacy of the 1933 bank holiday is the legal and philosophical precedent it established regarding the ownership of private property in the United States. When President Roosevelt invoked the Trading with the Enemy Act to shutter the banks and confiscate the gold, he permanently altered the relationship between the citizen and the state. He legally established that, in a time of declared financial emergency, the wealth of the individual is entirely subordinate to the solvency of the state banking apparatus. Your bank deposit is not your private property stored in a secure vault. It is an unsecured loan made to a highly leveraged speculative institution. When you deposit your paycheck, you become an unsecured creditor to the bank, standing at the very back of the line if the institution goes bankrupt. This legal reality was brutally reinforced and modernized in the aftermath of the 2008 Great Financial Crisis. When the global banking cartel imploded under the weight of toxic mortgage derivatives, the public was furious that trillions of taxpayer dollars were used to bail out the very institutions that caused the crisis. Politicians, sensing the lethal public anger, vowed that there would never be another taxpayer bailout. They kept their word by quietly engineering a mechanism that is infinitely more sinister: the bail-in. Through international agreements drafted by the Financial Stability Board and codified into United States law via Title II of the Dodd-Frank Act, the legal framework for the next bank holiday has already been meticulously constructed. The Orderly Liquidation Authority explicitly outlines what will happen when a globally systemically important bank faces imminent failure. The government will not close the doors and inject taxpayer cash. Instead, they will execute a statutory bail-in. Because you are legally classified as an unsecured creditor, the government has the statutory authority to freeze your checking and savings accounts and unilaterally convert your deposited cash into worthless equity shares of the failing bank. They will mathematically balance the bank's books by legally erasing your life savings. If you believe this is a theoretical, alarmist scenario, you only need to look at the nation of Cyprus in the spring of 2013. Facing a catastrophic collapse of their over-leveraged banking sector, the Cypriot government, at the behest of the European Central Bank and the IMF, executed a flawless, modern bank holiday. Over a quiet weekend, the government froze all domestic bank accounts and disabled the entire ATM network across the country. Citizens woke up on Monday morning entirely locked out of their wealth. When the banks finally reopened weeks later, the bail-in had been executed. Any citizen or business holding more than 100,000 euros in the Bank of Cyprus saw their funds above that threshold slashed by nearly 50%. The money was simply deleted from their digital ledgers and converted into fundamentally worthless bank stock to recapitalize the institution. The citizens did not make bad investments. They simply trusted the banking system. Their wealth was confiscated to pay for the sins of the bankers, and there was absolutely no legal recourse. Cyprus was the beta test for the modern bail-in architecture. The terrifying evolution of this control grid is currently being constructed under the banner of central bank digital currencies, or CBDCs. In 1933, to lock the citizens out of their wealth, the federal government had to physically mobilize armed guards, pull heavy steel grates over bank windows, and enforce the holiday with the threat of physical violence. It was a massive, logistically complex, and highly visible operation. In the impending era of a CBDC, a bank holiday does not require a single armed guard. It requires only a keystroke. A central bank digital currency completely eliminates the commercial bank middleman. Your money becomes a direct, programmable liability of the central bank. If the Federal Reserve determines that the economy is running too hot, they do not need to raise interest rates and hope the banks tighten lending. They can simply program a negative interest rate directly into your digital wallet, automatically deducting a percentage of your wealth every month to force you to spend it. If there is a banking panic and citizens attempt to move their capital into alternative assets, the central bank can instantly, algorithmically freeze your wallet, explicitly prohibiting you from purchasing gold, silver, or Bitcoin. They can implement geographical geofencing, preventing your money from functioning outside a designated smart city radius. They can attach expiration dates to your digital stimulus checks, ensuring the currency deletes itself if not spent within a politically mandated timeframe. The CBDC is the absolute terminal perfection of the 1933 bank holiday. It is a financial prison with invisible walls, where your ability to transact is treated as a conditional privilege granted by the state, subject to instant revocation without due process. The historical echo of 1933 is deafening. The mathematics of the current global debt supercycle are fundamentally broken. The global banking system is sitting on hundreds of trillions of dollars in unregulated off-balance sheet derivatives. When the next liquidity crisis hits, the doors will be locked again. The bail-ins will be executed. The wealth of the unsecured creditor will be legally harvested to save the institutional core. To survive this mathematical certainty, you must execute a personal, preemptive bank holiday of your own. You must ruthlessly reduce your counterparty risk. Money sitting in a commercial bank account is not your money. It is a digital IOU from a bankrupt entity. You must transition your wealth entirely outside the perimeter of the fractional reserve system. There is a profound historical reason why President Roosevelt threatened American citizens with 10 years in a federal penitentiary for the crime of holding physical gold. Physical gold and physical silver are the only financial assets on the planet that are not simultaneously someone else's liability. When you hold a sovereign minted silver coin in your hand, you hold absolute unencumbered purchasing power. It cannot be bailed in to save a failing hedge fund. It cannot be frozen by a central bank algorithm. It cannot be printed into oblivion by a desperate Treasury secretary. Taking physical delivery of precious metals and securing them in private, non-bank vaulting facilities or personal safes is the ultimate act of financial secession. Furthermore, you must secure the ultimate modern defense against capital controls, Bitcoin. Bitcoin is the cryptographic antithesis of the 1933 executive order. Because it operates on a decentralized, global network of nodes, there is no central authority to issue a bank holiday. There is no corporate headquarters to raid, and there are no vault doors to lock. If you hold your own private keys in cold storage, your wealth is mathematically unconfiscatable. You can transport billions of dollars of purchasing power across borders simply by memorizing a 12-word seed phrase, completely bypassing the surveillance and freezing mechanisms of the legacy banking cartel. The men who locked the doors of the American banking system in 1933 did not do so to protect the working class. They did it to protect the system that parasitically feeds upon them. That exact same system has spent the last 90 years compounding its leverage, writing the laws to legalize the next confiscation, and building the digital architecture to ensure you cannot escape. The next bank holiday will not be announced with a fireside chat. It will happen instantly,